Gold prices drop as trade optimism grows. Gold prices take a hit as trade tensions ease and risk appetite grows. Picture this. You're strolling through Dubai's gold souk, eyeing the glimmering jewelry displays, when suddenly the prices start to drop. That's essentially what happened on July 24th, as gold prices fell for the second day in a row due to signs of easing global trade tensions. Here's the deal. Spot gold took a 0.5% dive, landing at $3,370.69 per ounce by 45 p.m. ET. And it doesn't stop there. U.S. gold futures settled 0.7% lower at 3,373.5. But why this sudden drop? Well, it turns out the market is feeling pretty optimistic about some upcoming trade deals. First, there was the agreement between the U.S. and Japan, and now it looks like the European Union might be next in line. Akash Joshi from State Street Investment Management weighed in, saying that strong equities and low volatility have been putting pressure on gold's potential upside. But here's where it gets interesting. The US and EU are making progress toward a trade deal that could include a 15% baseline US tariff on EU goods, with some potential exemptions thrown in. This news comes hot on the heels of Washington's separate agreement with Japan. And if that wasn't enough to keep things unpredictable, US President Donald Trump decided to pay a surprise visit to the Federal Reserve later in the day. This move added an extra layer of uncertainty to the policy outlook, especially considering Trump's history of criticizing Fed Chair Jerome Powell for not cutting rates more aggressively. Despite all this, Doshi believes that any potential interference with Fed independence is supportive for gold over the medium to long term. The Fed is expected to leave rates unchanged at its July 29 to 30th meeting, but markets are still pricing in a potential rate cut come September. Now, you might be wondering why gold is so sensitive to these changes. Well, it turns out that gold is often seen as a safe haven asset during times of economic uncertainty. Plus, it tends to perform well in low interest rate environments. In other precious metal news, spot silver slipped 0.7% to $39.02 per ounce. Palladium dropped 3.5% to $1,234, and platinum lost 0.5% to $1,405.15. So, what do you think about all this? Do you agree with Doshi's assessment of the situation? Or do you have a different take? Let us know in the comments below. We'd love to hear your thoughts on this controversial topic. Gold price update. XAUUSD holds dip amid U.S. job strength and Fed rate hike bets. Hold on tight. Gold's latest dip is stirring up a heated debate on Federal Reserve policy. On Friday, gold continued its slide even though it still appeared on course for a modest weekly gain. This movement comes as traders zero in on unexpectedly strong U.S. jobs data, a sign that many believe will prompt the Federal Reserve to maintain current interest rates next week instead of cutting them. To break it down, gold was trading at around $3,358 per ounce, right after a 0.6% drop on Thursday. That decline followed a report showing that applications for U.S. unemployment benefits had fallen for the sixth consecutive week, the longest series of drops since 2022, with levels last seen around mid-April. For those new to market terminology, this essentially means fewer people are filing for unemployment, a signal of a strong labor market that can affect various investment strategies. Meanwhile, Treasury yields have been climbing higher. For beginners, it's important to know that when Treasury yields rise, they can make non-interest-bearing assets like gold less attractive compared to bonds that offer regular payouts. As a result, swap traders have slowly reduced their bets on the Fed cutting rates in the near term. Current expectations now lean towards fewer than 2 rate cuts for the rest of the year, with the first full rate reduction not anticipated until October. But here's where it gets controversial. While robust job numbers often indicate a healthy economy, could they also diminish gold's role as a safe haven asset? And this is the part most people miss. If the Fed opts to hold rates steady because of strong employment figures, does that decisively weaken gold's appeal? Or is there more to the story? We'd love to hear your thoughts on whether a resilient job market really undermines gold's unique investment value, or if there's another perspective to consider. Gold price forecast, July 25th, 2025. Why selling on rise is your best bet. Warning, gold's shine may be fading. Here's why you should consider selling on the rise. As we dive into the gold market outlook for July 25th, 2025, a stark reality emerges. The short-term prognosis for gold is decidedly cautious, with bearish signals flashing across the board. But here's where it gets controversial. Could this be the perfect storm for a sell-on-rise strategy to pay off? Expert analysis. Jatin Trivedi, VP Research Analyst, Commodity and Currency at LKP Securities, weighs in on the gold futures market, MCX contract, 5 Aug 2025, highlighting a continued downward pressure following a brief, lackluster recovery. Technical indicators, he notes, suggest that any potential upside is capped, setting the stage for a strategic sell-off. Current market snapshot. Gold rates hover around 98,749, reeling from a sharp two-day decline. Short-term moving averages paint a bearish picture, prompting a sell-on-rise strategy recommendation in the $99,000 zone, with a prudent stop loss at 99,450. Technical breakdown, unpacking the bearish signals. 1. EMA resistance holding firm. 8-period EMA, 98,735. 21-period EMA, 98,700. The price is wedged between these averages, unable to decisively break above either, reinforcing a weak recovery structure that favors short positions at resistance zones. Number 2, Bollinger Band positioning. The price's failure to convincingly approach the upper band, coupled with its rejection of the middle band, typically signifies low buying strength, increasing the likelihood of a price rollover near higher levels. Pivot points as resistance. Immediate resistances cluster between 98,950 and 99,200, with the $99,000 supply zone emerging as a key sell-triggered level for intraday traders, given its inability to be convincingly breached. Number 4, RSI analysis. At 51.98, the RSI has rebounded from sub-30 levels but struggles to sustain above 60, indicating a mid-zone reading that lacks bullish momentum, supporting the limited upside view. Number 5, MACD insight, implied from trend. Although a minor crossover might have occurred during the bouts, the MACD histogram is likely flat or mildly positive, lacking a strong bullish divergence to suggest a trend reversal, implying rallies are corrective. And number 6, price structure and reversal zones. The intraday chart shows a lower high, lower low structure, with the recent bounce appearing more as a technical pullback than a trend change. Selling near T resistance levels offers a favorable risk-reward setup. Conclusion. The short-term gold outlook remains cautious, with bearish signals dominating the landscape. Intraday traders are advised to consider a sell-on-rise strategy near 99,000, with a stop loss at 99,450, targeting potential downsides at 98,900 and 98,150. The confluence of weak momentum, resistance-heavy zones, and failed recoveries above moving averages points to further downside potential. Number conclusion. Do you agree that the gold market's current structure favors a sell-on-rise approach, or do you see a bullish turnaround on the horizon? Share your thoughts and predictions in the comments below. Number disclaimer. The views and recommendations expressed in this analysis are those of the expert and do not represent the views of the Times of India.